Algorithms that move the market. They do not panic. They do not hesitate. They do not feel doubt or fear. Yet every second, they decide where trillions of dollars flow, shaping markets faster than any human ever could. What began as a tool to improve efficiency has quietly become one of the most powerful forces in modern finance. To understand why algorithms matter now, we need to look at how decision-making left the trading floor. Human judgment gave way to code. Strategies were translated into rules, signals into triggers, and risk into mathematical thresholds. Machines took over not because they were reckless, but because they were consistent. Faster execution meant better prices. Better prices meant competitive advantage. As adoption spread, markets adapted around them. Prices moved in response to patterns rather than narratives. Volume surged as algorithms traded with one another, amplifying signals that no human ever consciously noticed. The market became less about valuation and more about reaction. Liquidity appeared deeper, spreads tighter, and volatility lower, at least on the surface. But this transformation altered market behavior at its core. Algorithms do not understand context. They respond to inputs, not meaning. When conditions remain stable, this works beautifully. But when signals conflict or data shifts abruptly, algorithms respond in synchronized ways that humans never would. What feels like intelligence becomes reflex. Firms optimize around this reality. Trading strategies were built to anticipate other algorithms rather than economic fundamentals. Speed mattered more than insight. Winning meant reacting first, not thinking longer. The system rewarded those who could operate closest to the signal source, compressing advantage into microseconds. Regulators watched carefully, but struggled to adapt. Rules designed for human behavior proved blunt against machine logic. Intent became irrelevant. Responsibility blurred. When thousands of algorithms act simultaneously, identifying cause becomes nearly impossible. The market moves, but no one truly decides. For everyday investors, the shift remained largely invisible. Trades executed seamlessly. Markets opened and closed on schedule. Stability seemed intact. Few realized that beneath the interface, decision-making had accelerated beyond human comprehension. These opening conditions reveal a system where control is distributed. Speed is power, and outcomes emerge from interaction rather than intention. Algorithms did not take over markets overnight. They were invited in one efficiency gain at a time. And once machines begin to move capital at scale, the question is no longer who is trading, but whether anyone is still steering. As algorithms became dominant participants, their influence reshaped the rhythm of markets in subtle but profound ways. What once unfolded over minutes now occurred in fractions of a second. Price discovery compressed. Reactions chained together faster than interpretation could follow. Markets no longer waited for consensus. They moved on correlation. Algorithms learned from one another. Strategies adapted to patterns created by other machines, reinforcing behaviors that rewarded speed and uniformity. When one model detected momentum, others followed. When one withdrew, many did the same. This created an environment where alignment happened automatically, without coordination or intent. Risk management evolved alongside this shift. Thresholds replaced judgment. Stop signals replaced discretion. Losses were cut instantly, but so was participation. In calm periods, this discipline reduced volatility. In stress moments, it removed liquidity at precisely the wrong time. The market did not slow down, it thinned. Institutions built layers of defense around these systems. Kill switches, circuit breakers, oversight teams monitoring dashboards rather than order books. But these safeguards assumed isolated failure, not synchronized reaction. When multiple algorithms reached similar conclusions at once, protections activated too late or not at all, the feedback loops grew tighter. Small price movements triggered responses that created larger movements. Data points fed strategies that amplified the data they consumed. Cause and effect blurred into reflex. The market began reacting to itself, independent of external reality. For regulators, visibility became a challenge. Orders appeared and vanished in microseconds. Activity fragmented across venues. Understanding intent mattered less than understanding interaction. Yet oversight tools remain focused on actors rather than systems. The market became a conversation no human could fully hear. Public confidence held, but quietly changed character. Stability felt technical rather than fundamental. Trust shifted from institutions to systems. As long as markets functioned, few questioned how. The complexity beneath the surface was accepted as progress. But beneath this apparent control lay a fragile assumption that algorithms would behave differently under stress than under calm, that speed would always equal safety, that automation would reduce, not redistribute, risk. Those assumptions had not yet been tested at scale. And when they would be, the response would not come from a single decision, but from thousands of machines reaching the same conclusion at the same time. The stage was set for a conflict where intelligence without understanding would collide with uncertainty, and where the market's greatest strength will become its greatest vulnerability. The conflict reveals itself when the market encounters information it cannot easily categorize. A sudden data release, an unexpected geopolitical shock, a sharp move without a clear cause. Algorithms process the signal instantly, but without context. They do not ask why. They react. Models built on historical relationships begin to break alignment. Signals conflict. Volatility spikes. Risk thresholds are crossed in rapid succession. One system exits. Another follows. Liquidity evaporates not because of fear, but because logic demands retreat. Each algorithm acts rationally. Collectively, the outcome is destabilizing. Prices gap faster than humans can intervene. Orders vanish before they can be matched. Market makers withdraw to avoid absorbing losses triggered by automated flows. The feedback loop accelerates. Selling creates more selling. Volatility feeds itself. The market begins to move independently of fundamentals, driven by mechanical response rather than valuation. Institutions struggle to regain control. Traders watch dashboards lag behind events unfolding in milliseconds. Risk teams scramble to interpret signals that no longer reflect underlying assets. Kill switches activate, but only after damage is done. Pauses interrupt trading, but they do not restore confidence. When markets reopen, hesitation remains. Regulatory mechanisms strain under the speed. Circuit breakers slow activity, yet cannot coordinate behavior once trading resumes. Oversight depends on reconstruction after the fact, logs, timestamps, fragments of interaction pieced together hours later. Real-time understanding remains out of reach. Public reaction is swift and confused. Headlines describe sudden crashes and recoveries with no clear explanation. Trust wavers, not because of loss alone, but because the system feels opaque and uncontrollable. When machines dominate movement, accountability becomes abstract. The deeper realization settles in quietly. Algorithms did not malfunction. They performed exactly as designed. The instability emerged from interaction, not error. Intelligence without understanding proved unable to distinguish signal from noise under stress. This is the heart of the conflict. Markets optimized for speed and precision lose the capacity for interpretation. They react before meaning can form. And once reaction replaces judgment, the system becomes vulnerable to its own reflexes. The question now is not whether algorithms should exist. It is whether a market governed by machines can remain stable when uncertainty refuses to follow predictable patterns. The reckoning arrives when markets are forced to accept that speed alone cannot create stability. After each sudden drop and rapid recovery, confidence returns more cautiously. Participants begin to understand that what looks like control is often just momentum behaving well. When conditions shift, the same mechanisms that once reduced friction can magnify disorder. In response, the system begins to recalibrate. Firms introduce limits that slow automated response during extreme conditions. Algorithms are redesigned to pause, stagger, or defer action when signals grow uncertain. Human oversight is reintroduced not as a replacement for speed, but as a governor, something capable of interpreting context when machines cannot. Regulators adapt as well. Oversight shifts from individual actors to interaction patterns. Stress scenarios focus less on isolated failures and more on synchronized behavior. The goal becomes containment rather than prediction, recognizing that not every shock can be anticipated, but its amplification can be reduced. Markets adjust their expectations. Liquidity is no longer assumed to be continuous. Volatility is no longer treated as a malfunction. Participants learn that resilience depends on diversity of response, not uniformity of reaction. Systems designed to behave identically under stress are redesigned to behave differently by choice. For investors, the lesson reshapes trust. Confidence no longer rests solely on technology, but on the balance between automation and restraint. Speed remains powerful, but it is no longer mistaken for understanding. Judgment regains value, not because it's faster, but because it can pause. Looking back, algorithms did not break the market. They revealed its assumptions. They showed what happens when efficiency outruns interpretation and when reaction replaces reflection. The system learned that intelligence without context can move capital, but cannot guide it safely through uncertainty. The future of markets will not be slower, but it will be more deliberate. Stability will come not from removing machines, but from accepting their limits. And in that acceptance, the system takes a step closer to enduring the moments when speed alone is not enough. Algorithms